What did I tell you? In the last few videos, I said watch $86. I said if that level holds, the bottom is in and we move higher. I said watch the SGE reopening after the Lunar New Year closure. I said watch what open interest does into first notice day. Every single one of those signals fired. Silver is trading $91 as I record this, up 44% from the $63 low. Gold is back above $5,180. And the people who understood what was actually happening in this market, not the Bloomberg headlines, not the paper price, they weren't surprised by any of this. Welcome, OG gang. Before we go further, I will never ask for your money. Never. No paid signals, no courses, no mentorship. If you see anyone using my name to sell you anything, it is a scam. Report it immediately. This channel exists because the truth matters and because most people watching this market are being fed a story designed to keep them confused. I make these videos to cut through that. This is financial warfare education, not financial advice. Protect your capital. Verify everything I say. Current levels as I record. Silver Western spot $91.12. Silver futures $91.45. Gold spot $5,181. Gold futures $5,194. Shanghai silver spot still running a $6 to $8 premium over Western price. The physical market did not lie through the crash. It is not lying now. Let's get into it. The call, the crash, and what actually happened. Let me be precise about what we called and when. Silver hit $121.67, an all-time record. We documented the warning signs in real time. The paper to physical ratio on COMEX at 7-to-1. Registered inventory draining at a rate that had no precedent. Shanghai backwardation screaming physical shortage. We said the structural case was intact, but paper volatility was extreme and leveraged positions were dangerously extended. Then the Warsh nomination hit January 30th. Trump nominates an inflation hawk to replace Powell. Silver dropped 47% in days, $121 to $63. The biggest single drawdown in silver's recorded history. And what did mainstream media say? Bear market, bubble popped, gold era over. What did the physical market say? Something completely different. While paper silver was crashing through $80, through $70, through $63, the vaults were being emptied. COMEX registered inventory fell from 103 million ounces to 88.2 million ounces in 3 weeks. Let me give you the specifics because the specifics matter. JP Morgan saw nearly 2 million ounces withdrawn in a single day. Brinks registered lost 345,000 ounces. CNT lost over 900,000 ounces. HSBC lost 305,000. StoneX registered saw 1.3 million ounces adjusted out. Nearly every vault on the COMEX network was being drained simultaneously while the paper price was collapsing. Think about that for 1 second. Paper price crashing. Physical demand accelerating. Vaults getting emptied faster than at any point in the last decade. These two things cannot both be true for long. One of them has to correct. And we said clearly, the physical market does not lie. It is not emotional. It does not panic sell. It does not respond to Bloomberg headlines. Physical silver left those vaults because real buyers with real money took delivery of real metal. The paper price was a temporary fiction. We are now watching the correction. The SGE reopening and what it means now. Here's the piece most people missed about the recovery timing. Shanghai closed for Lunar New Year on February 15th. 8 days of no Eastern buying. 8 days where Western paper markets had no counterweight from the world's largest physical buyers. And what happened during those 8 days? The shorts played, exactly as the data suggested they would. We covered this. I called it the 8-day manipulation window. Shanghai reopened February 24th, 1 day before this video. Look at what happened to the price on the 23rd and 24th. Silver was already reclaiming $80 into the reopening. By the time Chinese buyers came back to the market, the momentum was already building. And now today, the 25th, we are printing $91. The SGE premium is still $6 to $8 above Western spot. That premium has not compressed meaningfully since this recovery started. That is important. When Eastern demand normalizes relative to Western price, you see the premium compress. It has not. That tells you Chinese buyers are still in accumulation mode. They are not satisfied at $91. They are still paying up. Add to this the India data that came out this month. Gold ETF flows in India exceeded stock mutual fund inflows for the first time in history, the first time ever. That is not a small headline. That is a structural shift in how 1.4 billion people are allocating savings. Indian silver imports jumped 129% year over year. These are not speculative trades. This is wealth preservation at a scale that paper markets are completely unable to account for. The East is not selling, the East is buying, and now they are back at their desks. The technical roadmap, exact levels. Now let me be precise about where we are technically and what the chart is telling me. The crash ran from $121.67 to approximately $63.85, a 47.5% drawdown. We have now recovered approximately 44% of that move, and we are sitting at $91. The key Fibonacci retracement levels on this crash are clean. 38.2% retracement lands at approximately $86. We bounced off that level, consolidated above it, and held. That is now support. If you are watching this and you are not subscribed on X where I post the real-time charts, you are missing the live analysis. The handle 50% retracement is $92.88. That is the level I need you to write down. $92.88. That is the exact midpoint of the crash range. That is where the bulls and the bears will have their first real fight in this recovery. If we break above $92.88 and close above it on the daily chart, not just tap it intraday, but close above it, the technical path opens significantly. 78.2% retracement is $109.34. That is the next major target if $92.88 breaks, and then the psychological levels in between. $100 is not a technical level, it is a psychological one, but it matters because of how algorithmic trading responds to round numbers. Expect resistance and then a fight at $100. Expect the media to run a story about silver being overextended when it touches $100. That is the playbook. Do not fall for it. To the downside, $86 is now first support. Below that, $80 remains significant as a psychological level. A breakdown below $80 on high volume would tell me the recovery is in trouble, and I would want to re-examine the structure. But right now, $86 is holding and the momentum is clearly upward. One more technical note. The 150-hour EMA, which I mentioned in previous videos, was resistance on the way down and is now acting as support on the way back up. The recovery is structured. This is not a dead cat bounce. This is a market reclaiming territory. The 5-day window. Why this matters more than anything else. Here is what makes the next 5 days different from any other 5-day window in recent silver history. First notice day on the March COMEX contract is February 27th. That is 2 days from when I am recording this. Last trading day is March 3rd. Within this window, everyone holding a March futures contract must declare whether they are taking physical delivery or rolling to the next contract. The number I need you to understand is this. Open interest on the March contract represents exposure to approximately 429 million ounces of silver. COMEX registered inventory, the metal that is actually deliverable against futures contracts, stands at 88.2 million ounces, and it has been falling by an average of 785,000 ounces per day. February was supposed to be a quiet, non-primary delivery month. Instead, it posted 4,960 delivery contracts with a 98% delivery rate. Nearly every contract that opened stood for delivery. New buyers came in, demanded physical, took the metal, and left. This is not normal behavior. This is a market under physical stress. If the March open interest shows even 25% standing for delivery, 107 million ounces, that exceeds everything sitting in registered vaults right now. What happens then is the most important question in this market. Option 1. COMEX forces cash settlement. They have done this before. They changed the rules on the Hunt brothers in 1980. The rule is clear. CME Group can, in extreme circumstances, require cash settlement rather than physical delivery. If they do that, the paper market loses credibility permanently. Shanghai becomes the price-setting mechanism by default. Physical silver in the real world detaches completely from whatever number COMEX prints, and the price goes where the physical buyers are willing to pay, which, as the current Shanghai premium tells you, is significantly above Western spot. Option 2. They deliver the metal. Vaults get emptied further. Registered inventory falls below critical thresholds. The squeeze tightens. Neither of these outcomes is bearish for silver. Watch the open interest rollover data between now and March 3rd. I will be updating on X in real time. The macro is still intact. Let me briefly ground this in the bigger picture because I want new viewers to understand this is not just a technical trade. U.S. national debt is $38.4 trillion, growing at $6.17 billion per day. $10 trillion in treasuries mature within the next 12 months and need to be refinanced. Interest payments are running at $11 billion per week. And today, February 25th, JP Morgan published a $6,300 year-end gold target. Goldman Sachs is at $5,400, UBS at $6,200, Deutsche Bank at $6,000. When the largest banks on earth align on a number, they are not making a prediction. They are positioning. They are telling you where they already are. The dollar index is at 97.65, down 8.2% over the last year. The 10-year yield is at 4.03% and falling. Real interest rates are declining. Every one of these macro variables is a tailwind. China implemented silver export controls on January 1st. They restricted silver exports to 44 licensed companies. China controls 60 to 70% of global refined silver supply. This is the same playbook they ran with rare earths and gallium. And the U.S. just responded by adding silver to the critical minerals list and announcing a $12 billion strategic stockpile program. Both governments, on opposite sides of a trade war, have simultaneously decided silver is too important to leave to the free market. That is not a coincidence, that is confirmation. The Silver Institute projects a sixth consecutive annual deficit in 2026, 230 million ounces of demand in excess of supply. The cumulative four-year deficit through 2025 was 678 million ounces. Supply cannot respond quickly. 70% of silver comes as a byproduct of copper, zinc, and lead mining. You cannot drill a silver mine to fix this. Higher prices incentivize exploration, but new mines take 10 to 15 years to produce. The deficit is structural, and it is compounding. Bear case, because intellectual honesty matters. I will always give you the bear case because you deserve the full picture. The $92.88 resistance level is real. We have not broken it yet. If we get a rejection there, especially combined with any news on a US-Iran deal or a Warsh confirmation hearing that spooks the market, we could pull back to test $86. If $86 breaks on volume, $80 comes back into play. That would not break the structural bull case, but it would delay the timeline significantly and shake out leveraged positions again. Kevin Warsh is a genuine risk. If the Senate confirms him quickly and he signals rate hikes rather than cuts, the dollar could rally sharply and metals could reprice. That was the January 30th scenario. It remains possible. And always, COMEX can change the rules. They have done it before. Margin requirements can be raised again. Cash settlement can be forced. These are tools that exist and have been used. I am not telling you these risks to scare you. I am telling you because anyone who gives you only the bull case is either wrong or selling something. Assess the risks, size your position accordingly, and do not over-leverage. Close. Here is where we stand. Silver reclaimed $91. The technical structure is recovering. The physical market never broke. Eastern buyers are back after 8 days away. The SGE premium is holding. COMEX vaults continue draining. First notice day is in 48 hours. The level to watch is $92.88. That is the line. Break and close above that on the daily. The next conversation is about $100 and then $109. The paper crash was manufactured. The physical reality never changed. The vaults stayed empty through the entire sell-off. The Shanghai premium stayed elevated through the entire sell-off. The central banks kept buying through the entire sell-off. The U.S. government declared silver a critical mineral through the entire sell-off. None of that moved. Only the paper price moved, and now the paper price is catching up to what the physical market already knew. This is financial warfare education, not financial advice. Protect your capital. Think independently. Do your own homework. And watch $92.88